Brian Livingston. Again, welcome to the show. Really looking forward to your presentation. What do you got for us today?
Well, it's great to be here, Erin. And we have something that I think will help everyone who wants to invest in the market.
Yeah,
I know that people are sometimes with the market, sometimes they feel like they're fighting the market. And I don't think we need to feel that we're fighting the market. We want to move with the market, and that's what I'd like to talk with you about today. Shall we go?
Yep, go right ahead.
Something that we often realize is that computers, of course, are a huge part of investing these days. We used to do all of this with pen and paper. We used to do it with calculators. Now, if you don't have a computer, you don't have much to play with in the market at all. We are experiencing a great revolution, which is called Fintech for shorthand, or financial technology. This is something that goes beyond just having a laptop, something that goes beyond just having your own subscriptions to various computer services. If you were playing against the biggest chess grandmasters in the world, would you make guesses? No, you would use a supercomputer and you'd let the computer pick the moves for you. If you were on Jeopardy and you were trying to play the winners of Jeopardy, the champions, would you guess your answers or would you use a computer? Obviously, computers have excelled at both of these areas. They beat the biggest chess grandmasters and they beat the champions of Jeopardy. So now we are moving into a phase where people recognize that computers can do a better job than we can with our emotions. We see cats playing with red laser dots. And why do they do that? It's because the red laser dots move as though it were a bug or a mouse or something that they'd like to eat or chase. We need to realize that our own opinions make us move in the market the way that a cat chases a red laser dot. And of course, the cat will never catch the dot. It's just something that's an appealing kind of obsession. So when we allow our opinions to get in our way, we are fighting the market. We're not moving with the market. We're not letting the market tell us how we should be investing. And the truth is that academics, professors, Wall Street professionals have all studied what is it that really makes things go up and down in the market. And they know the answer. Now, I have brought out a book, Muscular Portfolios, and a website, muscularportfolios.com, which is revealing these secret formulas and giving it away for free. That's very important to me, that we don't charge anything for people to get these signals. We don't require you even to put in an email address. You don't have to register. You can get these signals absolutely free. Now, we want to look at how some of the greatest investors of our time have done what they've done. So everybody knows the name of Warren Buffett. Everyone knows that he is one of the most successful investors of our time. I'm putting a blinker on his performance. So from the beginning of the bull market, the bear market in 2000 to about mid-2015, he made 169% gain. That was more than double. It was triple or quadruple the gain of the S&P 500 between 2000 and 2015. So if we want to understand how we can be successful in the market too, we ask ourselves this question: how much did Warren Buffett outperform the S&P 500 during the last two bull markets? Was it A, more than 5 percentage points annualized? Was it B, 0 to 5? Was it C, he underperformed the S&P 500 during those time periods? Or D, we cannot determine it from the data available. And there's a poll that Stock Charts has been running to let people put in their answers. And we've seen scores of people responding to this poll, and you might be surprised by what the actual truth is. The truth is that Warren Buffett underperformed the S&P 500 during both of those bull markets. So if I put my blinker down here on the lower left, you can see that he actually went up during the bear market after the dot-com collapse in 2000 to 2002. If we look at the bear market of the global financial crisis, we can see that Warren Buffett lost only about 40% during that time, when the S&P 500 adjusted for inflation went down 56%. So he has beaten the S&P 500 in both of these bear markets. But look here, in the 2002-2007 bull market, Buffett only went up 56% and the S&P went up 90%. In the current bear market, this chart shows from 2009 to 2015, Buffett went up 150%, but the S&P 500 gained more than 200%. Now, the secret here is that Warren Buffett has a diversified portfolio. And this is something that anyone can do with their IRA. They can do it with their 401k. They can do it with a taxable account. We are teaching people through the book and through the site that they don't have to beat the S&P 500 during a bull market. At times, the S&P will be the strongest asset class in the world. So trying to beat it during a bull market can mean that you're making yourself take too much risk. It may mean that your portfolio is not diversified well enough to survive a bear market. And let me tell you, after this bull market has been going for more than 9 years, we will see a bear market coming in the near future. What people don't seem to understand about the market is how much keeping your losses small makes a difference in your portfolio. So here we look at an imaginary portfolio. What if you could keep your losses down to half of what the S&P 500 has lost in bear markets, and then you only gained 2/3 as much as the S&P in bull markets? The answer is that you would almost double the gain of the S&P 500 over this same period, 2000 to 2015, that we just looked at Warren Buffett's performance. Look at this. The S&P 500 went up 82%, but if you could keep your losses to half of the S&P 500 in down months, and you could get at least 2/3 of the S&P 500 during up months, you would have almost doubled the gain of the S&P 500 during this 15-year period. It's a very well-known secret to Wall Street professionals, but it's very seldom shared with individual investors. This is something that people are constantly hearing: beat the market every month. And you can't beat the S&P 500 every month when it's really in a strong uptrend. It's something that just at random, the S&P 500 is going to be the best performing asset that you can buy out there. It's something that you want to beat over your lifetime. It's something that you want to beat over a complete bear bull market cycle. So if someone is showing you their track record of how much they've made in the market, and they're not showing you at least one complete bear market and one complete bull market, they're yanking your chain. They're giving you a period of time that's too short to really say whether that person had a lot of skill or that person had a lot of luck. One of the traits that we see in the market is that for the past 30 years, 40 years, the individual investor has been recommended to hold a lazy portfolio. This is where you have 5 or more asset classes. It's easy to put together a lazy portfolio since we've had mutual funds for decades. We've had exchange-traded funds for at least the last 30 years. That makes it easy for us to put together a diversified portfolio, but these lazy portfolios perform poorly. This screen shows the recommendation from Morningstar, which is called the Aggressive Bucket Portfolio. They have 10 different exchange-traded funds that they recommend you put your money in, and you just keep the same percentage of those funds at all times. The problem with that is that it underperforms the market, and it has losses that are almost as bad as the S&P 500 itself. So if we look at the lazy portfolio in the global financial crisis, look here, it lost 34%. Most individual investors would find that an intolerable loss. They would sell all their equities and they would be out of there. The S&P was down 51%, but you can't take these big losses. What we find in the book, Muscular Portfolios, is that by keeping losses small, by being diversified in low-cost index exchange-traded funds, but by checking your portfolio once a month and making gradual course corrections, letting the market tell us what's going up and letting the market tell us what's going down that we should stay out of, we see in this 43-year simulation, the S&P went up 10% annualized. The Mama Bear portfolio, which is a very simple 3 ETF portfolio, went up 14% annualized, and the Papa Bear portfolio, which is a little bit slightly more complex, went up 16% annualized. These are results that we want to see individual investors get market-like returns, but with bond-like volatility. And so these losses like 18% here and 21% here, those are tolerable losses. You keep your money in the market, you don't bail out. MuscularPortfolios.com updates tables like this every 10 minutes while the market is open. So you simply go, get the information absolutely free, pick a day of the month, the first trading day, the last trading day, the third day of the month, your birthday, whatever you can remember. Go to muscularportfolios.com and choose one of these portfolios. The Mama Bear portfolio is shown here. You just buy the 3 ETFs that are on the top of the list. The formulas have been shown that these are the 3 ETFs that are statistically the most likely to go up in the next 30 days. There's no registration required whatsoever. It's absolutely free. We have a newsletter that we'd like you to subscribe to, and that updates the book, and that's free, and we also accept donations. This is not something that I am a financial planner, I am a financial advisor, I am not. I am a journalist, and I want people to have this information absolutely free of charge. The book is on sale at Amazon.com right now. They're taking pre-orders. It is shipping out from Amazon, Barnes & Noble, and these are the places on September 25th. So if you get in line right now, you'll be one of the first people to have this information in your own hands. Questions?
Do you have anything in the room, Aaron?
All right. You know, somebody had asked about, are you familiar with John Bogle's thesis? And did you have an opinion on that?
Yes, indeed. Jack Bogle is one of 3 financial experts that we have modeled in the book. So we have Jack Bogle from Vanguard, we have Steve LeCompte, who's the CEO of CXO Advisory Group, and we have Mebane Faber, who is the author of the Ivy Portfolio, a very well-respected book about investing. We have cloned in the book Muscular Portfolios these 3 gentlemen's portfolios. So without any cost, without any registration even, you can follow exactly the 2-model portfolio that Jack Bogle recommends, 9 ETFs that Steve LeCompte uses as his universe, and 13 ETFs that Mebane Faber uses as his universe. This is absolutely free.
Excellent. Somebody did make a comment, and I suppose you might even expound on it a bit more. As you were talking, somebody said, this is why I think it is malpractice when financial advisors tell you to stay exposed all the time and then justify it with the statement, invest for the long run.
Yes, that's exactly right. Let me go back to the website. I believe that individual investors are misled by people telling them, just hold on, don't make any changes, don't adjust your portfolio to the market. People need to hear that if they just check once a month, this literally takes 10 minutes or 15 minutes at the most. We have some months when there's no change in Jack's portfolio, Steve LeCompte's portfolio, or Mebane Faber's portfolio. You look at the website, muscularportfolios.com, the same 3 ETFs that were rated the highest last month are the 3 ETFs that are rated highest this month. You look at the computer, you see that there's no change, you turn off the computer and you go out and have fun. That's really, really easy, and we think individuals are all capable of handling this much. If people want to be day traders, that's fine. If you have a successful formula, that's great. Most people have a job, they have a family, they have a life. They don't have time to be trading the market from 9:30 to 4 every day. They want something like this, an easy way for their IRAs to be invested, an easy way for their 401ks to be invested. The difference in your wealth at the end of your working life, if you have a muscular portfolio, it can be many, many times what you would have at the end of your working career if you stick with a lazy portfolio.
Okay, and then somebody was asking, you know, how often do you rebalance the portfolios?
The muscular portfolios only need rebalancing if one of the ETFs is more than 20% off its ideal weight. So we've found that people who recommend you must rebalance if something is 5% off, that's wrong. You can wait until something has become 20% off its ideal weight. You are letting your winners run and you're cutting your losers short. That's a very big importance principle to anyone who is investing their money. With Jack Bogle's performance, he has only 2 ETFs that he is holding at all times, and that portfolio needs to be rebalanced only once a year.
All right. Right now, that's all I had in the chat room, but if I get some more, I will definitely interject. It would be nice, though, if we could get to your, just see the website a little bit.
Sure. What we can do is anyone can go to muscularportfolios.com. There's one page for the Mama Bear portfolio, there's one page for the Papa Bear portfolio, and there's one page for Jack Bogle's Baby Bear portfolio. So at that point, you can see exactly what we see on the screen right here. You can put in your email address and get the free email newsletter. That's perfectly up to people's preferences. We don't make any charges. We don't require any fees. And there's not even any need to put in your email address. But of course, you might benefit from the monthly email newsletter, which updates this and gives you the latest information.
Excellent.
Okay, I've got a couple questions for you, Brian, if you got a couple minutes, because this is not my style. I understand that it is the style of a lot of folks. I do follow the markets pretty closely, and for me, diversification, while it may be safer to someone who's not watching the market, diversification is just cutting into my returns because I'm investing in areas of the market many times that are not performing very well on a relative basis. And so I've got some money in areas that's performing great and outperforming, but then I have other money in different areas that are underperforming. And so I guess it's just my own personal preference to avoid those areas. How much, like when you're looking at these different portfolios, how much does relative strength come into play? And in terms of modeling these different portfolios, I guess how much is relative strength considered?
Relative strength is very important. We've found three principles that individual investors' portfolios absolutely need to take advantage of. One is compounding. You let your money grow over time. The second is diversification. You don't expose yourself just to one single asset class like the S&P 500. And the third is momentum. It's been shown in hundreds of academic studies that asset classes which have gone up the most in the past 3 to 12 months have a statistical likelihood of going up in the next 30 days. That's really a very strong tendency for asset classes. It may not be for individual stocks. Individual stocks are very volatile and very unpredictable. Asset classes are much more stable. You can see that emerging markets are going down. You can see that the U.S. market is going up. And the same with other asset classes like fixed income, commodities, and precious metals. That's what we're trying to teach people. If you are a day trader and you like day trading and you're making profits, that's great. If you have an IRA, if you have a 401k, you may not be able to trade rapidly and you may not have an interest in it. For example, federal workers have the Federal Thrift Savings Plan, or the TSP. That program is great because the government puts in matches for you to earn more on your portfolio, but you're only allowed to trade once every 2 months. That would be impossible for someone to day trade, but something like muscular portfolios would help those people grow over time.
Okay, I mean, I just pulled up a chart here just to kind of illustrate my point. And, granted, everyone's strategy is not going to be similar to mine. But when I look at the market, I take a look at the bull markets and the bear markets. And when you're going into a bull market, or while we're in a bull market, you can see the S&P 500 since bottoming back in 2009. I think everybody would agree that we've been in a bull market now for almost 10 years. And some of the things that I look for when I'm looking at the different areas of the market, for instance, I've got technology here relative to the S&P 500. And you can see that technology, for the most part, has been a steady outperformer in the S&P 500. You've got consumer discretionary, which went for about 2 years kind of sideways, kind of going along with the S&P 500. But you can see throughout the 10 years, it's been pretty consistently an outperformer. You've got industrials, which have been, again, an outperformer throughout the bull market with some periods of relative consolidation. And then financials, I mean, these are the four areas that I focus on the most. Financials have not been quite the same, but to be honest, what I expect out of financials is performance equal to the S&P 500. I'm not really looking, I don't view financials, especially banks and life insurance companies, I don't view those as particularly aggressive areas of the market, but you do want them to perform well to keep a bull market intact. And as I go down below, you'll see also that there are periods of strength in some of the defensive groups as well, like consumer staples and healthcare and utilities, these final three. But I find it personally better when the market is moving higher and you've got money rotating away from defense, like we've been seeing for the past couple of years, and into offense, like we've been seeing like I said, over these past 3 years. That to me suggests that you've got the market anticipating stronger economic growth. There's no real other reason why folks would be jumping in to these areas unless they expected that bottom lines were going to continue to increase pretty solidly. But these are the areas that I wanted to point out that have been performing pretty well. But then I wanted to bring up another chart, and I saw in one of the portfolios that you were listing there, the asset classes, gold was listed, and you can see that since 2011, gold relative to the S&P 500 has been moving down. So I'm not necessarily arguing with you, because I do believe that there are a lot of folks who really should be looking at some kind of a model that's more diversified, especially folks who are not watching the market on a regular basis. But when I look at a portfolio that's got gold in it, I'm just thinking all I'm doing is reducing the amount of money I should be making, because you've got a group, an asset class that has clearly been underperforming for a long time, and I continue to throw money at it. I just was wondering if you had any thoughts, or if relative strength comes in at some point to dictate how much goes into certain areas, or are there valuation principles that at some point come in and say, hey, you know what, this group is, from a value perspective, is just really looks really good, and as a result we're going to begin to start to overweight. How does that all, I don't know if I'm really being that clear, but
yes, of course.
How does the relative strength and all this relative performance of these various asset classes come into your thinking? How's that reflected?
The screen that we showed on the slide is months old. That's just from some point a year ago, maybe.
Okay.
As of today, in the Mama Bear portfolio, gold is rated 8th out of 9. So no one should have it because it's way at the bottom of the ranking in the menu. The Papa Bear portfolio, gold is ranked 12th out of 13. So it would not be in anybody's portfolio if they're checking the site once a month and they're upgrading to the top 3. The top 3 index funds are the ones that are the most likely to do well in the next 30 days. Gold is now nowhere near in the top 3.
Okay, that helped to clarify, because yeah. I saw those asset classes, and I saw the gold there, and that one of the things I've been preaching, and of course everyone's got a different take on the market. Gold goes through periods where it does pretty well over a short period of time, but I think this chart certainly, or the chart that I had up there, certainly suggests that the gold hasn't been a very good place to be.
That's a very good question. Why are precious metals in the investing universe? Why are commodities in the investing universe? During the global financial crisis, gold went up. When the S&P 500 was down more than 50%, an investment in gold gained 9, 10, 11% during that period. And our formula was keeping people invested in commodities, investing in gold while they were going up, and not any longer. So treasuries went up, gold went up, commodities went up during the global financial crisis, and that's what asset rotation means, is you move your portfolio once a month into those assets that are in uptrends, and you keep your portfolio out of assets that are in downtrends. How do you know? The formulas are completely disclosed, so you can see exactly why the computer has rated certain things to be in the top and other things to be in the bottom. There's no black box, there's no secrets, everything is right up front.
All right. I do have your website up. I had a couple more questions. One was stop loss systems exist for a reason. Why aren't they used on these portfolios?
You don't need a stop loss if you are rotating your portfolio once a month into the asset classes that are rated the highest. The New York Stock Exchange has prohibited stop loss orders. They do not protect people, and they do not get people out at the price they set. A stop loss order immediately converts into a market order, which can take you all the way down to the bottom. It's better to look at your portfolio once a month and to rotate into those asset classes that are strong based on momentum. Those are the ones that are not going to crash. Before the S&P 500 crashes, it always loses momentum. So it'll never be in the top 3 when it's about to go into a dot-com crash or a financial crisis.
All right. And then I noticed, when you've been talking about the different portfolios, the question was, what exactly is the difference between these portfolios?
The Baby Bear portfolio is a clone of Jack Bogle's 2 asset class portfolio that he's been promoting for 30 years. The Mama Bear portfolio is a muscular portfolio which selects from a menu of 9 index classes. And the Papa Bear portfolio uses a menu of 13 index funds that model the Ivy portfolio author, Mebane Faber, who has written many papers that are available on the web showing why you want to check your portfolio once a month and you want to use asset rotation and not stick with a lazy portfolio.
All right. Let's see. We have, what are your criteria for entry into an asset?
We are choosing to hold 3 index funds at all times. We show in the book that you actually make more money with less risk when you have 3 index funds to diversify your portfolio rather than just buying the one that's the top rated. So there isn't really an entry rule. You can look at the website at muscularportfolios.com, and about 3 months out of 12 there will be no change from the ETFs that were rated the top 3 1 month ago. About 9 times out of every 12 months you will see that there has been some change. So you will sell the ETF that's dropped out of the top 3 and purchase the ETF that now is in the top 3. That entry rule, these trends are slow enough that you don't have to worry about, do I buy it on the first day of the month or the second day of the month? Just about anything works, because actually with the Papa Bear portfolio, the majority of trades are long-term capital gains. That's important for people who have money in taxable accounts. You're not jumping in and out of the market every day. You're rotating gradually, and more than 50% of the sales that you make, you held that ETF for more than 12 months.
All right. Let's see. I think that pretty much covers the ones I have. If I see any more, I'll get them to you. But here is the website. The book is here. And, you know, with Chrome, I think some people were having a bit of an issue to get to the website. But if you just do just type in muscular portfolios.
There's no space.
You're going to get it right there. And
well, it's a good thing that we show up in Google on the top hit for our own name.
Yeah, that's always a good thing, right?
Very good. That's a very good thing.
So yeah, that's one way to get to it. I know on Chrome there were a little bit of issues, but that's the easy way to get there. And yeah, there's how you can get the newsletter, and it all looks great. Tom, did you have anything else?
Not really. I mean, I think the questions that came in were really good ones, and I think Brian did a good job of answering those.
We should mention the poll. We had that poll up, and actually the majority of people who replied to the poll said that Warren Buffett beat the S&P 500 during the last 2 bull markets. And as we saw in the presentation, Warren Buffett actually underperformed the S&P 500 in the last 2 bull markets. It's entirely because he keeps his losses small during bear markets that he is one of the world's greatest investors and with the best performance.
Excellent.
That's amazing. I don't know if I would have said, what were those choices? What was it was greater than 5% or more than 5 percentage points annualized, 0 to 5. I think I probably would have gone 0 to 5. I mean, he's not somebody who, goes out there with major risk, but I probably would have been with the 20%.
He is an absolutely phenomenal investor, truly a financial genius. And think of all of the articles, the thousands of articles written about Warren Buffett, and which ones of them told you that he underperforms the S&P 500 during bull markets? Almost none of them. We really need individual investors to understand this. It's not high risk, crash your money, risk taking that makes you a successful investor. It's keeping your losses small and knowing how to use diversification and momentum that makes your portfolio soar.
Absolutely. Well, it certainly was great having you on here, Brian. Again, go to www.muscularportfolios.com. Check out the website, and hopefully we'll get you back on here soon, Brian.
Great, Tom and Aaron. It's been fantastic talking with you.